Innecco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Dr. Thorsten Polleit. We spoke back in June 2020. That was the last time. And I've known Thorsten for a very long time. He was the exception to the rule in the financial sector. When I worked in the city, I used to read a lot of the Mises.org literature, and he used to contribute and still does to the Mises.org website. And he was the chief economist for Barclays Bank in Germany. And Thorsten, you were also the chief economist at ABN AMRO in the late 90s, early 2000s. And I worked at ABN AMRO as well, which is a bit of a coincidence. So I've got Thorsten today to speak about what's happening in continental Europe. Yes, I know exactly, or I know well what's going on in the UK, and fairly well what's going on in Europe, Germany. But I thought it would be interesting to get a view from Thorsten, who is in Germany. And Thorsten, maybe you could update us on what you're doing now, and maybe something that I missed from your background. And thank you for coming on the channel again.
Thank you very much, Mario. It's always a great pleasure. And you know, I'm a big fan of what you're doing. I think you're doing a fantastic job. You're addressing the right issues. You explain people how messy it has become in our monetary system and what it implies for their personal incomes and savings situation. So I hope you keep up your great work, and I'm sure you will do. And again, you're doing a fantastic job. And so I'm very glad to have the opportunity to chat with you about these issues, what's going on in continental Europe. Well, let me add, after my banking career, I moved into the real money business. I work since April 2012 for Europe's largest precious metal trading house, Degussa. I support the firm as a chief economist. You know, I'm paying a lot of attention to what's going on in the global financial and monetary system. I also, of course, look at what's going on in the real economy. And most importantly, of course, what it implies for precious metals investors. And you invite me to share some thoughts about what's going on in continental Europe. And as you know, the situation is pretty difficult. It has become pretty difficult. And I know from your many videos that you have fully analyzed the underlying problems that plague the euro area. We have a fiat currency put into place that was put into place in early 1999. And it hasn't worked from the beginning, and now the problems build up. The euro area as a whole moves from one crisis to the other. At the moment, the so-called energy crisis has become very severe. All kinds of prices, all kinds of energy prices go up. It's not only the Russian gas that has become so expensive. It also affects coal, electricity, oil, and it will crush. If there's no quick solution to the euro area currency crisis, I fear it will crush the economies. In particular, Germany will be hard hit because still Germany has a strong industrial base. It's energy intensive production. And so the energy crisis puts Germany in particular under severe stress. And I think we are just seeing the beginning of this crisis.
Yes, and it looks now that governments around Europe and even the UK as well are bringing in new stimulus to solve this crisis. It seems crazy. I even saw that Germany put forward 65 billion euros to help with the cost of living or energy crisis. And at the same time, the ECB still has rates around zero. They did raise it last time, and they're expected to raise rates. But with CPI going up at double digits, and even PPI, I think in Germany is almost at 40%, it seems like they're way behind the curve. Maybe you could go over your view of the energy crisis, because a lot of people don't see it as a monetary phenomenon. They see it more as a geopolitical crisis. The fact that Russia is after being sanctioned, it started stop the flow of gas. So maybe you could cover that right now.
Yeah, that's very important. Thank you for that, Mario. Many people these days think the high consumer price inflation is a result of Russia invading and making war in Ukraine. But I don't think that's the true story. Inflation is always and everywhere a monetary phenomenon, as the US economist Milton Friedman put it. And I think he's right. Inflation is the sustained increase of goods prices over time. That means all prices go up, not just one price, but all kinds of goods and commodity prices move up over time. And that is what inflation is. The rising goods prices is the symptom of an underlying cause. And the underlying cause is the increase in the quantity of money issued by central banks in close cooperation with the commercial banking system. And just to give you some numbers, since the early 2020, the US central bank has increased the money stock M2 by around about 40%. 40%. In the euro area, the money stock M3 was increased by around about 20%. And because the economies haven't grown that much, a huge monetary overhang has been built up. My estimate is that in the euro area, for instance, the monetary overhang is around about 15%. And that means there's an additional increase in the overall price level of 15% coming. So either prices go up by another 15% in 1 year, or if it extends over time, maybe prices will increase by around about 7% per year for 2 consecutive years. So there's a lot of inflationary pressure still in the pipeline, and I'm afraid that central banks won't shrink the money stock. So the price that people will have to pay is higher inflation. So inflation is not a natural catastrophe. It is man-made. It is central bank made. And the same can be observed in the United States of America. Monetary overhang, according to my estimate, of around about 15%. So the same thing will happen. And it will result in a debasement of the purchasing power of money. So money will be the great victim of the monetary policies delivered in the past. Of course, some cost push effects are at work, and also some demand pull effects are at work. Like, for instance, the rise in Russian gas prices, which translate into the increase in other energy prices, has an effect in the short term on these energy prices, but they can only translate into inflation, namely a sustained rise in all goods prices across the board, if there's such a huge monetary overhang. I think that's important to understand. This inflation is not Russian-made, it is central bank policy made. And I fear that in the coming years, we will have to cope with very high inflation, and there is now I think a heightened risk that this period of high inflation will translate at some point into hyperinflation.
Yes, and I mean, Germany, of course, has had experience with hyperinflation a couple of times in the last 100 years, 1923, and also in the post-World War II era. And we're seeing central banks and mainstream economists that don't have the luxury of having learned about the Austrian school, saying that more fiscal stimulus is going to help bring inflation down. And I think that's crazy. I spoke about that in a recent video. Here in the UK, we got a new prime minister, and they're gonna spend 200 billion pounds almost to bring the CPI down. Just a gimmicky move to say, oh look, CPI, or inflation as they call it, has come down. But yes. What are your thoughts on hyperinflation? The more and more I see the way the world and our leaders are acting, the more concerned I am. But at the same time, hyperinflation would be, I think, a blessing in disguise. It would destroy this whole fiat currency system. So what do you think are the probabilities?
Well, in the last years, I have increasingly dealt with the theory of hyperinflation, so I'm glad that you bring up the issue. You know, hyperinflation, if you look into economic textbooks these days, you would find a definition for hyperinflation, which basically comes from the US economist Philip Kagan. And he said in the 1950s, hyperinflation means if goods prices increase by 50% per month. So if you annualize this number, you get an annual inflation rate of round about 12,900%. And that means a cup of coffee, which costs you, say, £3 today, would rise to, the price would increase to £390 within 12 months. Wow. So it's a frighteningly high number. And I would argue that basically hyperinflation starts at a lower level. I mean, if you have, let's say, inflation rates of 15 or 20% on an annual basis, I think there's reason to term that hyperinflation. So what I'm saying is we are pretty close to that definition from my point of view. And of course, it could get worse. The problem with hyperinflation is that it is a politically orchestrated destruction of the currency. The government, if it can no longer issue bonds in the capital market, if it can no longer increase taxes, it will take recourse to the central bank printing press. It will simply start printing the money it wants to spend. And that's what's happening. You mentioned, for instance, in Germany, these rescue package, support package, whatever you call it, trying to cope with the energy crisis. These 65 billion, that would be around about 2% of German GDP, is not that much. But the question is, how will it be financed? It won't be financed through higher taxes, that's sure. It will presumably be financed by issuing more debt that is being bought then by commercial banks or the European central banks against issuing new money. So the freshly created money is then handed out to the people so they can keep spending, but at the same time, goods prices will increase. So inflation will be brought up. And that, of course, eliminates the positive effect initially felt by the people. So what I'm saying is inflation is always a politically orchestrated debasement of the currency. Quite often it seems inflation seems to be the lesser evil for governments, but also sometimes for the broader population. People prefer new money over getting a real severe recession, defaulting banks. And this is because inflation, you know, it's like it's a bit like drinking, you know, when you drink, it's nice, you're having a good time. The next day, you feel miserable. With inflation, the fun comes first and the costs come later. And so there's a strong political economic incentive to take recourse to inflationary policies to overcome obstacles in the economic or societal system. And when you look at the crises in the let's say last 10 or 15 years, what you can observe is that the problems are getting bigger and the responses are getting even bigger in terms of money printing. And I think that's exactly the route that will lead us towards a situation of a very severe debasement of the currency, and in an extreme case may imply hyperinflation.
Yes, and you talked about drinking, that it's fun when you start drinking and you have a few drinks, so you keep drinking, and then the next morning you have a bad hangover. And some people would they'll call it hair of the dog. You then you drink again in the morning and you get better. And it seems like that's what we're doing in terms of the governments and the central banks. They're not allowing people to have a bad hangover. They keep bringing out the punch bowl, and that's what concerns me too. And I just wanted to switch now to maybe the ECB and the Bundesbank and what's happening in Italy, because as you said, inflation is a political situation, just like Felix Sommeray, which you probably heard of him. The He's his biography is called The Raven of Zurich. He was a banker in the early 1900s, and he said that inflation without government is not possible. So how do you have any hope that the Bundesbank maybe and the German people are gonna revolt against the ECB, so to speak? I noticed that at Jackson Hole, they didn't have Lagarde there speaking on behalf of the ECB, but they had a German central banker, and she seemed to be quite hawkish. I don't know, maybe you can clarify that for us.
We talked already about the euro fiat currency. It is as the dollar, as the British pound. I mean, we live in a world, in a regime of fiat currencies. Fiat currencies are monopolized by state-sponsored central banks. It's created basically through credit expansion. Whenever a bank issues a loan to a private household or a company, it increases the outstanding money supply. And fiat money is a kind of money that is completely dematerialized. It's just in the form of bits and bytes on computer hard drives with the production costs of zero, basically. And it's very tempting, you know, for governments or political special interest groups to take recourse to money printing, you know, to enrich themselves at the expense of the broader population. And this fiat money system has been put into place basically with the end of the gold backing of the US dollar on 15th of August 1971. And since then, the world is on a fiat money system. And we know from economic theory that the fiat money system causes trouble. Like it debases the currency, the purchasing power of money loses over time. It causes boom and bust cycles, and most importantly, it leads the economies into a situation of over-indebtedness, a situation where private households, firms, and especially governments can no longer basically repay the outstanding debt. And so the central bank cuts interest rates to basically zero to prop up the system. And that's kind of an end point reached, so to speak. Going beyond that means full-scale money printing. And I think we are somewhere in this area. I don't think there will be a change in this kind of policy, I'm afraid, because the adjustment costs would simply too severe. Governments will do everything they can. No one wants to take responsibility of the mess that has been built up over the last decade. So when you look at monetary history, it's, you know, the lesson that can be drawn from the experience in many countries is that a fiat money system will end in the debasement of the currency, a heavy debasement of the currency. In an extreme case, the currency will be destroyed, like in the Weimar Republic in November 1923. I may add, this was, as I said, an extreme outcome. In Austria, for instance, the government succeeded in stopping hyperinflation in the early 1920s, in early 1923. So they preserved the krona at that time. So the currency did not go under, was heavily debased, but could be used by people after the printing presses stopped. In Germany, as I said, the currency was destroyed. I cannot tell you what the outcome will be in terms of whether currencies will survive or die. But I think it's pretty obvious that the purchasing power of money will be heavily debased. And that applies, I'm afraid, in particular to the euro currency.
Thorsten, could we go over CBDCs? Because I read an article you wrote recently about CBDC and also the competition of cryptocurrencies and Bitcoin and the free market in money. And explain to the public or to the viewers that CBDC is really not a free market solution.
Money has originated in a free market system. Money originated from the voluntary transactions among people. I think that's very important to note. Money is not a creature made by governments. Money has emerged spontaneously out of the free market system. And so I'm very much in favor of a free market in money. And so I'm have great sympathies for what's going on in the crypto space. And I hope these guys will come up with a better solution, giving people a better money compared to the US dollar, the British pound, the euro, and the rest of the fiat currency pack. So I'm very optimistic also that finally people will succeed with coming up with a better monetary solution. And of course, central banks will try their very best to fend off any kind of currency competition. They are currency monopolists, and they don't want to have competitors. And so they try with tax and regulation to restrict the opportunities that would come with a free market in money. The central bank digital currencies, that's actually a very complex issue. And there are many perspectives that need to be looked at. But in general, and to cut a long story short, I'm very critical about this development, because what it means is that digital central bank currencies would drive out cash, would drive cash out of the market. People will lose the opportunity to make anonymous payments. The central bank would basically have perfect oversight into your financial transactions. There would be no financial privacy left. It smells a bit like a totalitarian idea to get full control over the monetary system. And so, as you can see, I'm very critical. Weighing the pros and cons of such a development, I would recommend, to the benefit of the people, there should be no central bank digital currencies going forward. And the best solution for our monetary problems around the world would be a free market in money. So people would have the opportunity to use the pound or the US dollar, but maybe gold or other crypto units. It should be a decision made by the people. It should, what kind of money they wish to use in their daily transactions for the saving purposes. It should not be forced upon the people, as it is the case in a government-sponsored money monopoly, which has been, as I said, has put into place in the US, in the United Kingdom, and in the euro area. So the solution, I think, for the monetary mess that can be observed around the world would be a free market in money.
Yes, and to wrap up, maybe you could talk about the German retail sector, the German public. I've always heard that Germans, because of the history of the last 100 years, have always been big buyers of gold and silver too. Maybe you could talk about whether you think that's going to help the majority of Germans survive or cope with what's coming, or if it's a small minority and maybe compared to other countries?
Interestingly enough, in the early 1920s, I remember that Ludwig von Mises, the Austrian economist Ludwig von Mises, put out an article in which he recommended to his fellow people to diversify their currency holdings, to exchange the Austrian currency, the krone, against US dollars, against the British pound and other valuables. And his idea was that once the crisis hits, people would have some value in their portfolio. So gold was, of course, one of the items Mises recommended, because the US dollar at that time was fully backed by physical gold. And yes, I think the idea of diversifying the portfolio away from fiat currencies into real estate, into stocks, into precious metals, that's the way forward. In Germany, for instance, people, in terms of savings, time and demand deposits, hold around about 4 billion. 4 billion euros sit on bank accounts with basically zero interest rates. And if you reduce or take into account the current inflation of 9%, you lose around about 9% or 8 or 9% per annum at the moment on your personal savings, and that is a very bad allocation. One opportunity for people is really to get away from these bank deposits and put at least a part of their financial wealth in physical gold and silver in the form of bars and coins. I would highly recommend to acquire physical stuff and not, put your money in a gold ETF or a gold certificate. You just feed Wall Street with your money and provide them with plenty of opportunity to manipulate precious metals markets. And so go for physical gold and silver, because over time, that is a time-tested approach. Gold has been around for thousands of years. Paper monies come and go. Gold remains. And I think we live in a world where you have to take into account that, or face the fact that these fiat currency systems won't last forever. And what's pretty sure right now is that the debasement of the purchasing power of the dollar, of the euro, of the Japanese yen will gain steam.
Yes, and I noticed you said, 4 billion euros in time deposits, and you have 8-9% debasement per annum. But I've noticed that the gold price in euro terms is up about 8% year to date. So gold is doing its job in euros. In pounds, we're up about 10%. So it's doing what it says on the tin. And I think for American savers, it will do so eventually. And I think that the dollar right now is strong by default. And silver as well, of course, hasn't done well. But I expect they can't manipulate the paper price forever, because we know that when you try to cap prices, you create shortages. And it's not just with consumer goods and services, it's also with money, I would say.
At the moment, you rightly point towards the dollar. The dollar is the strong man at the moment. Many investors many people might be surprised hearing me saying that, but still, the dollar is the world's reserve currency, and in times of crises, investors increasingly try to get hold of US dollar deposits. And the dollar is appreciating not only against the euro, it is appreciating against the British pound, against the Swiss franc, and in particular against the Japanese yen. And so for investors at the moment, the dollar is the first choice. Even gold doesn't enjoy this kind of support at the current juncture. But in terms, the gold price in Japanese yen has gone up sharply because the yen has depreciated so strongly against the dollar, and the same can be observed for the euro gold price. It has gone up in the last years, and provided gold holders with a nice gain. But I think what's really important is to have insurance. Gold is not just a commodity. Gold is money, and gold is also an insurance against the vagaries of the fiat currency system. So it's basically an option in your portfolio. People may wonder at the moment why it doesn't trade the gold price at 2,000 or 2,200. And my answer is, at the moment, many investors are still quite confident that central bank will manage the fiat currency system nicely. So whenever it's a crisis, they will step in and lower interest rates and prop up credit markets. And I think this is a realistic assumption. But I think people forget the broader consequences of this policy. It will result in a heavy debasement of the currency, and gold and silver will protect investors and savers in the long term against these inevitable losses.
Great, Thorsten. It's nice having spoken to you again after just over 2 years. Is there anything final that you'd like to tell the viewers, and maybe tell the viewers where they can find some of your work?
Yeah, again, thank you very much, Mario, first and foremost, for your invitation. It's always great talking to you, and I hope you will continue your great work, and I'm sure you will do. It's important to enlighten people, to open people's eyes about what's really going on, and to provide them with an opportunity to escape the drastic consequences this fiat currency system will have on their lives, on their personal savings situation, on their pensions. So I think we should continue with this great work. People can find me on social media, on Twitter, on LinkedIn, on Telegram. I post my comments, and I post my works. You will find links to some articles and podcasts. They can also visit my English YouTube channel. And yeah, I hope people will make use of it and find it useful and helpful to make better investment decisions.
Oh, okay, great, Thorsten. I will put the links to your details below in the description, and I wish you a great rest of the day.
The same to you. Thank you very much, and hope to see you soon, Mario.